Hello and welcome to Pro Trader Strategies Market Commentary for Unenjoyment Friday, July the 7th. My name is Eric Wilkinson. Some of you may recognize me as the Wolfman from CNBC, Fox Business, or even the Wall Street Journal for my commentary on everything from economic to geopolitical and market analysis. Please keep in mind that everything that we talk about in these market commentaries is not a solicitation to buy or sell any of these securities or strategies. At the end of the day, we're here to teach you some different strategies you can implement into your portfolios, but please do that in your own way. The reason why I can't give you a recommendation on a particular stock or strategy is because I don't know your risk parameters. I don't know what's in your portfolios, and therefore what I'm doing could be counterintuitive to what you are already doing. Please remember that past performance of any trading system or methodology is not necessarily indicative of future results. Having all of that out of the way, let's get it on. We do have a lot of economic data here and across the pond. Basically, European area, French, German, came out with better industrial production numbers. German industrial production month over month came out at 1.2%, was expected to be 0.2%, so much better than expected there. We also got French industrial production coming in at 1.9%, was expected to be 0.5%. Then getting over into Great Britain, not such a rosy picture there. We got manufacturing production there, came in at negative 0.2%, was supposed to be a positive 0.5%. And then we also got construction output in Great Britain, came in at negative 1.2%, was expected to be a positive 0.6%. Then there was also a revision to last month's number, revised it to down negative 1.1% from negative 1.6%. So actually revised it up to a negative number still, but that may have been a little confusing. Then here in the United States, we got the non-farm employment change, which is the big unenjoyment number. That's the one that I look at the most. Some people, mainstream media, will talk about the unemployment rate, but the real number is the non-farm employment change, and that increased 222,000. Was expected to increase by 175,000. That's the new hires. They also revised last month's number up from 138 to 152. And remember, last month's was a pretty big miss to the downside, but that got revised up. Then we got the unemployment rate. It upticked to 4.4% from the 4.3%. Now that number kind of showed up in the ADP. Now this is the reason why, for one, we don't really look at the ADP or put a lot of merit to the ADP because it's off, generally speaking. The U.S. non-farm payroll number that came out today is the one that is the most widely looked at. But something that did show up in that ADP number was that people were kind of claiming unemployment, more people claiming unemployment. So despite the fact that we're seeing the unemployment change by increase in hires, we're also seeing some people come off of the discouraged workers, if you will. So those are the people that have kind of stopped filing for unemployment and are now going back out into the job force and looking again. So they kind of come back into that number. So that number can be a little bit skewed in a sense. Sometimes you'll see that number come off even though there's not very much employment going on, and that has to do with people falling off of the unemployment line. Anyway, and then we also got natural gas storages came in at a build of 72 billion cubic feet in storage, expected to be 61 billion cubic feet, so a build of 11 billion cubic feet over that was expected. Anyway, on to crude oil and the broader markets. Crude oil off another $1 today. Yesterday we were talking about it got above that 61 Fibonacci level. It looked to me like it was going to kind of hang out there, maybe even press a little bit higher. But again, we are still in that negative trend. Has not created a newer low, but we are still seeing the lower lows and lower highs. So this market looks a little broken, now down testing this value area low, which is going to act as support as that $43 a barrel area that I talked about. I threw that line in there. that is more of a psychological level, but it has shown up several times as support. So we could easily see it go down, break through that value area low, and test that support level. And now we're looking to see if it goes down and test the 42 handle. Right there is the low of 42.08ish. 42. The low is 42.26. It says right there. Might be on the wrong. Might not want to go over there for it, but anyway, it looks like around 42.08. I think it was. Anyway, it's not wanting to work with me. So $42 would create a newer low. Having gone through all that, that's where we kind of settle out. Now we're seeing the gold futures. Remember we got these tweezer tops up here. Now looking pretty bearish. As a matter of fact, one could almost call this a head and shoulders in a sense, be a stretch, but could somewhat be called a head and shoulders with the neckline right here. Breaking below this Fibonacci level, this market is definitely on pace to come down and test the 23 fib level and possibly even the value area lows. So this market seems to be wanting to go down. With the unemployment numbers that we've seen, that market's going to go up. People pulling out of gold and putting money to work in more risky assets, if you will. The flight to safety off the table. People are going to probably be coming back into equities. The bonds, same situation here. The unemployment number being pretty good. Most of the numbers we've been getting out are pretty decent. They're not robust by any means, but that would lead one to believe that the Fed is going to continue to raise interest rates. So if interest rates go up, bonds go down. Same thing we've been talking about for some months now, right back down to the point of control, which is where I thought it should be for this last rally here. I was a little bit perplexed as to why it was rallying, despite the fact that we were going to see increased interest rates. I still have on my short TLT position. It's coming in very nicely, not quite to where I'm at my percent of max profit that I'm looking for, but it is starting to work out quite nicely. Then on to the overall equities. As you can probably tell with the bonds being down, equities are going to be up. Dow Jones up almost 100 points today. Pretty much regained most of the losses that we saw yesterday. Opened up a little bit higher from the overnight sessions of the equities rallying, and now we are at yesterday's highs for the most part. Then with the NASDAQ, same situation, really engulfed the yesterday's sell-off. We're really getting back and forth and have gone nowhere for the past week for the most part. The market's just having some major movement, but at the end of the day, we kind of end up at the same place as we were last Friday. But the NASDAQ up 67 points right now, doing quite well above yesterday's highs. Then on to the E-mini S&Ps, not quite the same picture, but it is really pushing higher, looking to test those highs from yesterday. Dogs coming in. It's a beautiful thing about dogs being able to open up doors. Then this is the picture of the E-mini S&Ps on the 30-minute chart. As you can see, we have rallied past the opening of yesterday and are trying to retrace some of yesterday's overnight trade. So overall market really blasting off on that economic data that we got there. Now onto a few trades that I've done. XLE, if you remember, I put this in my IRA. XLE was selling off today. With the data points we saw yesterday and the economic picture now, economy starting to move, you're going to start to see more people utilizing the oil and gas kind of things, which is the energy sector. It's all in there. So with that sell-off, that was the directionality I wanted. If you remember, I had on a short call spread in there. And with XLE, I had on the July, I left on the call. So I had on the July 66.5, 69 call spread in there. and originally sold it for around 31 cents. So 50% of my max profit was target that I was looking for yesterday. And I talked about this with these short calls, or with these call spreads that we have on that are short in our IRA. Remember, we're trying to define that risk on the short call so that it makes it acceptable to the powers that be that make up the rules, that you can't have a naked short call in there. So I talked about how to define that risk in order to kind of get around that rule. And in that, when the market goes in my direction and I'm able to get out for 50% of my max profit, which is what I was trying to do yesterday, but those calls just really aren't worth anything. It's really riskless to leave those on. I'm going to lose maybe a penny on that long call if I leave it on, and if I cover it, I can only sell it for about a dime, or sorry, about a penny. So I'm not really risking a whole lot there in my eyes. So in that, I went in and bought those 66.5 calls back, and I paid 9 cents for those. So that was better than 50% of my max profit. With the move down today and a little bit of volatility contraction, I was able to get out of those quite nicely. So I've left on the 69 long calls in there, and I doubt that the market's going to rally up there in the next 14 days, but at the end of the day, there's not a whole lot of risk in leaving that on for a penny. So that's what I've been doing in my IRA for the most part, especially when I'm creating these synthetic short, naked short positions. So XLE just covered one side of that spread. Now with General Mills, ticker symbol GIS, got into a long position here. It looks like, kind of gapped down. They beat earnings and they've just gotten beat up. I think it's kind of overdone to the downside. We're getting a little extended here, not seeing a whole lot of volume traded down here, which is leading me to believe that the sellers are kind of falling by the wayside. Therefore, looking for a bullish position in General Mills. So I put this actually in both my IRA and in my margin account. And the reason why, it's got pretty low implied volatility, no earnings coming up, so I just decided to do a long call spread. Came in very close to my rules on this, so I decided to go ahead and put it on. I did the October, so I went pretty far out. Bought the 47.5 calls, sold the 60 calls to pay for that extrinsic value that is embedded in those 47.5 calls, and I paid $6.42. So, the 50% of the max, or 50% the width of those spreads would have been right around $6.25. Paid a little bit above that just because I'm pretty bullish on this at this point, thinking that we're going to get a up move. So I gave up 15 or so cents. So I'm also working to get a Nike trade on that is a bullish trade as well, but that has not come to fruition. All right, and then on to what I've done in my margin account. Adobe, added this position in there. Adobe, I'm pretty bullish on all of these. I'm bullish on NVDA. I already have a couple positions on in there. EA Sports, bullish in there. Adobe, I think all of these are going to do very well. This tech sector is going to probably start ramping up again. So with this pullback and the move higher, decided to go into Adobe and do a bullish trade, and went in there and sold the August 130 puts for 94 cents. Now, the IV is just slightly below 50 IV percent, so I'm bending that rule just a little bit, but pretty bullish on Adobe. It's got pretty high implied volatility. Looks like implied volatility is starting to roll over, so hopefully I can get my directionality, some of that IV to come out. So I did kind of tweak that rule just a little bit, but a lot of other ancillary things kind of really put me in the position to want to put on that trade as selling position with a slightly lower than a 50% IV percent, I should say. Then on to Apple. Apple, we have taken off, or I took off. I talked about this yesterday. It's come down here to this level and bounced off of it several times. Today started moving higher. Confirmation that it looks like it's going to rally up and away from it, at least for the near term. I only had this trade on for a few more days, the next for this expiration cycle, so I didn't want to risk any more. I've gotten that move. I decided to cover it. Not quite the 50% of max profit, but it was a nice trade nonetheless. And it was in the July, and I had bought the 149 puts and then sold the 142 puts. Now the deal was that I wanted to come down and test those 142s. Got into the 142 handle for a little bit there, here and there, kind of testing that. Just didn't come all the way down there. Yesterday was a little bit better trade, and I originally paid in this $3.24 and sold it out for $4.23. So made $1 on it. Could have made a little bit more. I was trying to squeeze out that extra yesterday, but today with that move higher, decided to pull the ripcord on that one. And then that's about all I've done today. I'm working a couple of trades to get out of NVDA and add Verizon and LULU, or get out of my, Verizon, ticker symbol VZ, and adding LULU, but neither one of those are super close, so kind of letting those ride out right now. That's about all I got for you guys today. Today's webinar is going to be on the short call spread, so I'm going to talk about how you can build that out two different ways. One that is going to have a synthetic type of short call that you could implement into your IRA as a synthetically kind of just naked short call, and then as a call spread with some of my rules wrapped around that and how you build that out. So go to protraderstrategies.com. I haven't been able to talk about all of those rules and all of the different things in these daily market commentaries because that gets a little long in the tooth, but I'll be able to do that in this webinar, and you can ask questions back and forth, which makes it a little bit better of a webinar because you will be able to ask the questions that you want to ask. All right, so go to protraderstrategies.com and sign up for that. If you can't take that, take it easy.